new investment insight series, Magellan Minutes, in which our investment team dissect the markets and take a deeper look into sectors and stocks in our global portfolios. My name is Jennifer Herbert, Key Account Manager at Magellan, and over the next 10 minutes, I'll be talking to Magellan's Head of Macro and Portfolio Manager, Arvid Streimann, about our current macroeconomic views. Thanks for joining us, Arvid.
A pleasure, Jen.
Arvid, perhaps we could start with an update on Magellan's current economic outlook. How different is the economy looking now compared to the pre-COVID landscape?
Sure thing, Jen. Now, this is something that we think a lot about, and obviously the growth outlook is worse than it was before the current crisis. And when we think about it, it seems to us as though the recovery is probably going to be slower than what a lot of people and markets expect. And let me explain why. The first reason is when we think about the virus, curves have flattened, but the risk of second wave of infection is still there. And there's a lot of uncertainty around that. So what can governments do? Well, the only thing that they can really do is stagger the opening of the economy. And that means that the economic recovery is going to be slower than it otherwise would be. We think that it's probably going to take too long to get a therapeutic or a vaccine, which would allow economies to open straight away. So we're not hanging our hat on that. But overall, that would argue for a slower than usual economic recovery. Now, the second thing is the sheer scale of the slowdown. Now, a lot of people have been put out of work, and we know that a lot of businesses have lost a lot of money. Now, it's going to take a long time for people to find a new job and start spending again. But what's really interesting is their behavior. So if you were that person that had just lost their job and had somehow managed to find a new job and you needed to buy a new car, you may be sitting there thinking to yourself, you know what, I'm not going to buy this car this year. In fact, I'm going to push it out to next year, even though I can buy it now. I'm just not going to. I'm going to be a little bit more cautious. And on top of that, I might just buy, a cheaper car than I was going to buy before. That's slower growth. And on business side of things, they'll probably do something similar. They may need a new piece of machinery, a new computer or a new worker, but they'll say, look, you know what? I don't want to hire that person right now or buy that new computer right now. I'm just going to wait an extra year. Now, the third thing here that I think is really important is the political side of things. So when the coronavirus first started hitting Western economies, we were pleasantly surprised at the reaction of governments in bringing a relief package through Parliament. Now, what's really interesting about that is that governments typically don't work that smoothly. There's usually a lot of argument, but what happened was that both sides of government, the opposition and who was in government, came together and said, you know what, this is just such a horrible outlook that we're staring down the barrel of, that we just have to do something. Now, when we look forward, when government spending moves from that relief package stage to a stimulus package stage, that bipartisan approach may not actually exist anymore. And what that means is that if we're waiting around for this stimulus package, it might be too late or later than what we would hoped, or it might actually be a bit smaller than what we had hoped.
So it sounds like you think a V-shaped recovery is unlikely.
Yeah, exactly. Now, we think that there are four potential scenarios here: V-shaped recovery, a U-shaped recovery, a deep and prolonged recession, and the worst possible outcome would be a depression. Now, we think that the V-shaped recovery, as I kind of hinted, is probably not really that likely. And we would say that the depression, or the worst case scenario, is kind of unlikely as well. So we're really focused on those two middle scenarios and really figuring out which one of those it's going to be. Now, at this early stage where we still don't know which way the virus is going to go, we don't really have a strong view. I don't think anyone has a strong view or high conviction in which one of those two it's going to be. So at the moment, we say, look, it's equally as likely at this stage that it's going to be a U-shaped recovery or a deep and prolonged recession.
Perhaps we could drill down on different regions and how they're managing during this pandemic. Which economies are faring better than others, and how different will the recovery look for each?
Yeah, Jen, that's a very important question. And on average, we think that developed markets are going to do a little bit better than emerging markets, and let me explain why. The first reason is that when we look at emerging markets, their health systems just aren't quite as good as those in the developed markets. So when it comes to the severity of the outbreaks in each country, the emerging markets are going to take a bigger hit. And then when you're thinking about what the governments are going to do to protect their economies and stimulate their economies, it seems as though it's going to be harder for these emerging markets, because we've got to think about when a government is stimulating its economy by giving people money, the government first has to get that money. And the way that they usually do that is by borrowing, so going into the bond market. Now, if you're a borrower going into the bond market, it's harder to borrow money at a good rate if you have one of three things. And the first one is that you have a high level of debt already. So if you're a highly indebted country. The second is if you don't borrow in your own currency. So if you borrow in the US dollar, not your own currency. And the third is that if you're an economy which is relatively undiversified, and here you may think of some countries that are overly reliant on oil, for example. Now, we look at the emerging markets, and most of them kind of tick 1, 2, maybe 3 of those boxes. And, you know, I think it's really important to say that there's a bit of a spectrum here. So maybe some of the developed markets, countries, actually fall into that category as well. And I'd sort of call out Italy here and say, you know what, I don't think that they borrow in their own currency. That's a bit cheeky, but they borrow in euros, not lira. And they already have quite a high level of government debt already. So, you know, it is a spectrum. We think that on average, developed markets will do a little bit better coming out of this than emerging markets. But it doesn't mean that all developed markets will do better than all emerging markets.
Arvid, what about China? Where do they fit in?
Well, Jen, China's pretty unique in that the government can actually tell businesses to reopen and tell businesses to start rehiring. In other countries like the US, businesses actually have to want to reopen and have to want to rehire their workers. And what that means is that China can probably restart its economy a lot quicker than a lot of other countries. The trick, of course, for China is that it's a major exporter to the rest of the world. So they can open up all their factories, but they really need the rest of the world to buy all the stuff that they're producing. And so that is something that they really need to thread the needle on. But like everyone else, China's growth rate is going to be lower than it otherwise would have been, but we think that it's still going to be a lot higher than that you get in most developed markets.
Finally, Hamish has recently spoken about higher PEs in a protracted low interest rate environment. Do you think this thematic still holds true in a post-COVID world?
Yeah, look, Jen, the first thing I would say on that is that, you know, what's happened is that the interest rates are going to be lower than they otherwise would have been because of what's happened. So in terms of, do we still believe we're in a low rate environment? Yeah, and it's probably, we feel even more strongly about that. We also think, to get to your question, we also think that interest rates are going to continue to support PEs. Now, you know, it's not exactly what's happened in the last, let's call it 3 months or so. So let me explain why. Now, when we think about PEs and what impacts PEs, there are actually 3 things. There are interest rates, which we've talked about. There's the growth outlook. And then there's uncertainty. And uncertainty is, you know, how confident or worried people are. We know that if people are confident, they'll tend to bid up PEs. But if they're worried, like they were, then they'll tend to not want to pay as high a PE as they otherwise would be. Now, looking back over the past few years, we've talked about this a lot, PEs did expand with lower interest rates, and that was actually really easy to see. And the reason was because the other 2 components that I mentioned, which is the growth outlook and uncertainty, they didn't really move around so much. So you could actually see the impact of lower interest rates pushing up PEs. Now, when markets fell, when the coronavirus started to take hold in Western economies, what happened there was that this uncertainty that I mentioned earlier really picked up, and that forced down PEs, and it was really quick and it was really large. What we've seen with markets more recently is that they've rallied again, and we would argue that that is the uncertainty reducing, which is pushing up PEs. Now, that's really interesting to us, and we debate this a lot, is because we don't actually think that uncertainty around the economic outlook has really declined that much, although markets seem to think otherwise. So to get back to your original question about interest rates, we do think that they're going to support PEs. It's just that you can't see it right now. So when we come out the other side of this crisis, when uncertainty is back to a sort of a more stable level and the growth outlook has stabilized, then you're really going to see the impact of lower interest rates and their support for higher PEs.
Arvid, thank you so much for your insights. If you have any questions, please don't hesitate to contact one of the Magellan team, and please feel free to share this update with clients or colleagues as you see fit. Take care and stay safe.